Turning to Investing 101, the stock market is doing fine, so is the economy, but that isn't always translating to investors. As the Trump administration makes major changes, we have Juli Niemann, a stock market analyst based in St. Louis, here to help. Juli, what are you hearing from investors?
High anxiety. And that's what we're seeing virtually across the board with investors, with everybody. You've got a government now that is in complete upheaval, an economic system that is moving on, but doesn't know how to deal with something like this. This is like nothing we've ever had before. So planning is kind of out the door when everybody you've been dealing with has basically had agencies shut down, supply lines, wondering where do we go next? What do we do? So planning has become extremely difficult for most corporations, especially in manufacturing, distribution, you name it. The only ones who are still on par or have normal business happen to be the retailers, some of the service companies, medical. So those areas, even though they're in medical, there definitely are huge problems with reimbursement. We don't know where that's going either. But the key thing is here, investors are trying to find, is there an area for safety? And bottom line, you have to remember you've got to stay very flexible in this environment.
What do investors need to know about making that happen so they're still getting solid returns? Here's your list of some do's and don'ts with investing in bonds. You say, don't buy private debt packages. Do consider high quality corporate and government bonds. Do consider short-term government T-bills and bonds. What else?
The core function you must look at is building and maintaining a portfolio that can withstand some pretty sharp winds that are crossing the economy right now. If you look at the fundamentals on the economy, we're okay. We have been for 3 years. We've been growing nicely, growing steadily, in spite of all the bad news that keeps coming in over the rafters and everything. The economic news has been very good, but there's a high degree of uncertainty right now. One, we've got inflation that is not coming down anymore. But we talked about this a few months ago. There's a core rate of inflation that takes a long time to take out. One of the best ways to cure that rate of inflation is to have a knockdown, drag-out recession. Crude but effective. We don't want that. So we're looking at a core rate of inflation that's getting pretty much stuck here at 3%. And the Federal Reserve basically is going to stay tighter, not intervene too much anymore, but just stay tighter longer. Interest rates simply aren't going to be coming down much in the near term. And a lot of investors were counting on that to act as more of a stimulus for spending, especially when you're talking about houses, cars, things that you would buy on time that are sensitive to interest rates.
Thank you, Juli.
My pleasure.